Based on the past 50 years of data, these are the 5 warning signs that the AI bubble is about to burst. So the first warning sign is unprecedented valuations. So you gotta go to this website called macrotrends.net, and then you can find this S&P 500 PE ratio, okay, a 90-year historical chart. So when you scroll down here, you realize that the shaded areas over here, these are recessions, past recessions. So you can just focus on these gray shaded areas. Now you can see that the most recent few ones, 1990, which is caused by the Japanese market crash, is less of a big deal as compared to the next few crashes, but we still gotta take note of it. You can see that it rised all the way to 16.99 before it crashed. Okay, but if you look at the most recent few crashes, 2000.com crash. Before it crashed, it went all the way up to 46.50. Now you realize that back then, those tech stocks, those tech companies which were not even making money, they were going up, overvalued, overpriced. And yet people buy it based on what? Greed. So there's a lot of speculative behavior going on when the price no longer justifies the company's earnings, it becomes overvalued. And you realize that in any market bubble driven by a certain specific sector of stocks, there are only a handful of hot stocks, hot companies that are driving the rise of the S&P 500. This S&P 500 PE ratio is based on GAAP, which is an accounting practice. Okay, you don't need to care too much about that, but it is based on trailing 12-month PE ratio, meaning it is measured based on net income earnings, which is not that accurate because net income can be manipulated too with non-recurring items and also non-cash items. But let's not go into that. I don't want to confuse you too much, but you can see that based on the past few recessions, you see a major spike in the S&P 500 PE ratio before it crashes. You can see that in 2008 recession, it went all the way up to 122.39. And 2020 over here, not too much, but there was still a spike, 27.73. As of the making of this video, 29.30. I wouldn't be surprised if it goes beyond .com levels because there are a lot of smart traders who think they're smart investors who told me, Karen, AI stocks are different. This time is different. This is the most expensive sentence based on John Templeton, and most people will still not learn from history, and that's normal. And people are gonna say this time is different because now it's AI. It is more amazing than the old tech stocks. Whatever you say. Now then, how do you know which sector is driving a bubble at one point in time? Of course, you already know the answer, but you can actually check it. You can go to this website called finviz.com, and then what you need to do is to go to groups over here, and you can see that based on 1 day performance, tech, 1 week performance, again mainly tech stock, communication services, technology, 1 month performance, top 3 indeed is driven by tech stocks as well. 3-month performance, half year performance again in the top 2, 1 year performance in the top 2. And the top 10 hot stocks that are driving the S&P 500 right now, you can actually do a quick check whether these stocks are overvalued or not. In order to do that, you need to go to this website called Simply Wall Street. Now, put link in the description below. And you can see a summary over here, earnings forecast to grow, but there's a high level of non-cash earnings in Nvidia. I know a lot of you like this stock, but we want to look at the valuation, which is the main thing. Scroll down over here, it is 22.5% overvalued. Now, of course, intrinsic value calculation, it is very subjective because it is based on growth projection. But if you're holding, chances are you already know that Nvidia stock right now, the reason why it is increasing is not because the earnings justify the price increase, but it's because a lot of people are buying it out of FOMO, out of greed. And the second sign is shopping spree. And what kind of shopping spree? Not so much of consumers going on a shopping spree, but mainly companies going on a shopping spree, massive spending spree. Now, last week, Oracle's stock price went to an all-time high. Oracle is one of the top 10 stocks driving S&P 500. In fact, there's a name for it, Magnificent Seven. There's a special group name for it. Now, of course, I won't rely too much on news because news are meant to get clicks, but it is clear that a lot of these tech giants, they are investing heavily into AI, and it's good because you want to take advantage of the trend. But if the investment doesn't lead to a massive increase in profits as well, then that could be dangerous. If they are investing billions into AI hardware, cloud contracts, chips, but the profits aren't catching up, then it's a warning sign that the price increase is driven by hype rather than earnings. As you can see, there are a lot of these tech companies, they're overvalued right now. If you have watched my investing video, you already know, okay? Because the intrinsic value is the real value of the company. Let's say it is $100, all right? So let's say the current price is over here. From this point all the way to here, intrinsic value, the price increase is driven by the fact that, okay, the company fundamentals are good. So it's justified. This level over here, it is justified, meaning it makes sense. So it's good. Beyond that, any price increase beyond the intrinsic value, it is not justified because it's driven by greed and hype. So you gotta know the difference. Doesn't mean that price increase, meaning oh the company is gonna do well, company is making good money. There are two different types of price increase, if that makes sense. So the third sign is when big tech is pulling back. Now this is quite similar to the tulip mania. What happened was that okay, people are buying all these tulip bulbs, right? Which are driven to sky high prices. And then one day when people realize what nobody's paying for it anymore, there's no demand anymore, then they stop buying it, then the whole thing crashed. Companies like Microsoft, they are canceling and pulling back from more data center leases because when companies eventually realize that okay the demand is not keeping up with expectations, this is an early warning sign that the oversupply is building up. So if you see companies cutting down on their investments, canceling on their projects, then that is one of the warning signs as well. Now I will give you two more indicators, okay? This fourth warning sign is retail FOMO. Now you can use this index called the Fear and Greed Index from CNN. As of the making of this video, the overall sentiment is greed and it's measured based on these few indicators. The first one is market momentum, and of course the S&P 500 is above your 125-day moving average, 100-day moving average. Take note of this over here. It says greed, all right, and based on stock price strength, it shows extreme greed right now. Stock price breadth, greed, put call options. Later I'll talk about this, okay? Put call options, it's very powerful indicator. And VIX, which I also taught you in my sentiment analysis videos, what numbers represent what. And these are so-called systematic ways of measuring sentiment, but you can get an overall sense of it. Like you go to social media, almost every new retail trader, 19-year-old, 18-year-old is making money. And then they be like, hard work pays off. Okay, you only been in the markets for 6 months. So when the typical person who hasn't been in the markets for a very long time are making money easily, almost everybody is making money on social media, then you know, okay, people are getting complacent right now. And also when you see every person on the street is talking about meme stocks, meme coins, you already know. When you know, you know. And you can understand that when it comes to volatility index, VIX, which measures level of fear and greed in the market, there's no fixed value as to say, okay, beyond what value people are being complacent, but this is a general guideline I want to give you. When it is less than 20, people are being complacent. When VIX is between 20 to 39, people are starting to become fearful. When it is beyond 39, people are starting to panic. Okay, so right now this is at 15.54 as of the making of this video, and you can understand that VIX, it tends to respect support and resistance zones a lot of times, and this coincides with a U-turn in the stock market. If you want me to elaborate more about this, let me know. I'll do that in the next video, so stay tuned for that. So you gotta look at two things: the absolute number of VIX and also price action right now. As of right now, it is bouncing off. When it goes further below again, people are becoming complacent again. Even though right now, people are already pretty complacent. Now the next indicator, very powerful. This is one of the top indicators that you can use to measure market sentiment. You can go to this website called Micro. So this is the CBOE, total put call ratio. To put in simple terms, okay, when you buy a call option, you're expecting the markets to go up. When you buy put option, you're expecting the markets to go down. So this is the ratio of put and call. So this means that when you have a high put to call ratio, this means that people are more bearish. When you have a low put to call ratio, this means that people are bullish. So this means that when put call ratio is at an extremely low level, it might also a signal that markets are topping. So let's look at the past few recessions. Again, you can see that the gray areas over here are the recessions, okay? You can see that before the March crash, our put call ratio went all the way to 0.76 before market crashes. And in the dot-com crash in 2000, the ratio was around 0.6, 0.7. And in 2008, it dropped all the way down to 0.5. As of the making of this video, it is at 0.84. So when it drops below 0.7, that is when things are getting dangerous, because it tells you people are dangerously complacent. Okay, of course, there are 5 more indicators that you need to look at aside from put call ratio. I'll put the video somewhere over here so you can check it out. So with that, I'll talk to you in the next video. Bye.